on one hand, they want to bring inflation down. On the other hand, they don't want to create a huge recession. And that's where, what will happen? That's where time will tell. But as a financially educated person, this is where I say you got to be educated, understand what's happening. That way you don't just follow the headlines, but rather you can make smart decisions so you can capitalize on opportunities. Because the reality is market crashes and recessions create more millionaires than any other time. And that's where if you are aware of what's happening, you can capitalize on it.
On today's episode of the What the Finance podcast, I have the pleasure of speaking with Jaspreet Singh, who's a serial entrepreneur and founder of the Minority Mindset, which is a really great channel that I enjoy watching. So, Jaspreet, thanks so much for coming on the podcast today.
Well, thank you for having me on. It's really a pleasure.
No problem. And I'm really looking forward to speaking with you because you have some interesting insights, I guess, into the world and what's currently happening. So, I guess from your perspective, what are the current macroeconomic drivers you're watching and that you're paying close attention to?
The most important things are the intersection right now of inflation and interest rates. See, inflation is an interesting thing that we're dealing with right now because it's not the inflation that we're seeing right now, but rather the trend of inflation and how it's been moving. Because if we go back to 2020, when the pandemic hit and the Federal Reserve Bank and the government started the stimulus and quantitative easing, the common theme was there's no inflation possible. We're not going to see any inflation. That's not a concern. Then fast forward a little bit, we started to see a little bit higher inflation. And that was when the Federal Reserve Bank, who's our central bank here in the United States, said that inflation is transitory. Nothing to worry about. It's going to fall back down very quickly. And then fast forward another 6 to 9 months, and that was when the Federal Reserve Bank said, okay, inflation is not transitory, but we have it under control. It's nothing we need to worry about yet. Fast forward another 3-4 months, and that was when the Federal Reserve Bank said, okay, inflation is a problem, and we need to fight inflation, but we're worried about it in the future. Fast forward a couple more months, now we're in the early part of 2022, around March of 2022, and that was when the Federal Reserve Bank did the first interest rate hike. It was a 25 basis point hike, meaning 0.25%. And they said that we don't have to be too aggressive, maybe a few interest rate hikes, and we'll have the inflation problem under control. Fast forward a few more months, and now it's not 0.25% interest rate hikes, it's 0.75% interest rate hikes, and the Federal Reserve Bank says we're going to have to stay aggressive to bring inflation down. Then it was, yeah, we have to raise interest rates, but it's not going to affect the economy. The economy is going to be strong. Then we started to see more layoffs in the tech sector. We started to see more issues in some companies struggling with their debt payments. And that's where kind of we are today, where inflation is still very high. It has come down off of its highs, but inflation is still high. And then at the same time, we have yet to see the impacts of the higher interest rates. And today, with the higher interest rates, we went from hearing that there'd be no impact onto the economy to recently the Federal Reserve Bank saying that their prediction, their base case, is that we're going to see some sort of mild recession because of the higher interest rates. So we have the higher interest rates, which are slowing the economy. We have still the high inflation, which is hurting the economy. And then obviously we have, the economic slowdown, which is we're seeing the economy slow down faster than expected. This is what the data tells us in the most recent GDP report, which is our economic report. What it said is that the United States economy grew a lot slower than expected last quarter. So now the question is, okay, where are we going to be in 12 to 24 months? Because yes, inflation has come down, but it's not down to the 2% level. In fact, it's still pretty high. And there's two different inflation numbers you can look at. One is CPI, one is called core inflation. And CPI is essentially looks at a whole broad list of things. Core inflation just strips out things like energy and food prices, which is what's considered volatile, quote unquote volatile. And the Federal Reserve Bank likes to look at core inflation more than CPI. CPI is what hits all the headlines, it's what hits all the mainstream media, but the Federal Reserve Bank says that they like to look at core inflation. And core inflation is higher than CPI, and core inflation is stickier, meaning it's tougher to bring down. Because if you look at the core inflation numbers, it hasn't really fallen that much off of its highs. And so that's where you kind of bring all this information together and you say, all right, what does this mean? Inflation is still high. High inflation hurts the average person. Inflation means that the average person is seeing their savings values drop. They're seeing the value of their paychecks drop. They're seeing the value of their wealth drop because the average person is just a consumer. And at the same time, high inflation is also now hurting the economy because if your rent is more expensive, your groceries are more expensive, you have less money to go and shop at other places. So that's pain for the economy in other places. And then at the same time, higher interest rates also impact the economy. Why? Because now borrowing costs go up. And it's not just the fact that you have to pay more money to now go out and buy a new home, but also if you are a business or if you are the government, you don't have 30-year fixed rate mortgages, you have adjustable rate mortgages. And what we're going to see happen over the next 24 months is we're going to see a huge chunk of the outstanding corporate debt readjust at the higher interest rates, which means the cost of servicing these debts are also going to rise.
Yeah, it's really interesting. And I know a key aspect of, I guess, the core inflation is shelter. And that's something that is quite a lagging indicator. I think it's the way that the US measure it. So, and I think a lot of other measures as well are lagging. So do you see the potential that we could, similar to, I guess, other inflation metrics, we could see that decrease and then maybe the disinflation sort of happen to the core as well? Or do you think this is more of a trend where we're going to see higher inflation, even with the recessionary pressures that you were mentioning?
Well, understanding first, what is the cause of inflation? A lot of people have been pointing fingers at the cause of inflation, but inflation has one root cause. It is money printing. Inflation comes from the word inflate. What are you inflating when you have inflation? You're inflating the monetary supply. So when you increase the amount of money out there, and then you give it to people or you give it to businesses, which is what we saw happen in 2020, 2021 on an extreme level, demand, meaning buying power, goes up. Businesses have the ability to open more stores. They have the ability to hire more employees. People have the ability to buy more homes. They have the ability to buy more handbags. They have the ability to buy more groceries. Now, demand goes up. Now people have the ability to shop. Businesses now have to produce more stuff. And now because businesses have to produce more stuff, they now have to start paying more money. They're seeing their raw material prices go up. Their labor costs start to go up. And so now the cost for businesses start to go up. And so then this ultimately causes the price of things to go up. So inflation causes the price of things to go up as a byproduct of inflation. So now when you talk about the recessionary indicators or the recession factors, could that impact inflation? Absolutely, because that could impact demand. And that's where now the Federal Reserve Bank is trying to walk a thin wire where on one hand, they want to bring inflation down. On the other hand, they don't want to create a huge recession. And that's where, what will happen? That's where time will tell. But as a financially educated person, this is where I say, you got to be educated, understand what's happening. That way you don't just follow the headlines, but rather you can make smart decisions so you can capitalize on opportunities. Because the reality is market crashes and recessions create more millionaires than any other time. And that's where if you are aware of what's happening, you can capitalize on it.
Yeah, I agree. So you've mentioned before that you think the property market will be hit, and as you said there, bankruptcies just because of the cost of capital is going up, and obviously there's pressures on the economy. So yeah, do you think we will see maybe similar to 2008 these property collapses, or do you think it will be a little bit different to there? What's your thoughts on that?
It's very different than 2008. In 2008, what we saw the growth of subprime lending. We saw the growth of 0% interest rate lending, which created a boom and a huge bubble in the housing market, which ultimately burst. And when that burst, the housing market collapsed, then trickled down to other parts of the economy. What we're seeing now is not a housing market issue. What we're seeing is a broader economic issue, an inflationary issue. This is, some people call it the everything bubble, where it's multiple different asset classes, not just the real estate market. The real estate market is actually a little bit different, but we have other asset classes, the general economy that has been inflated thanks to the easy and cheap debt. And so the higher interest rates now can hurt the general economy, which could then trickle down to the housing market. In 2008, it was the housing market collapse that trickled down to the economy. Today, it's kind of the opposite, the economy that could trickle down to the housing market. So that's the difference between now and then. But what is also different is the commercial real estate market. And I think that's even more significant, because what we have going on right now in the commercial real estate market is that, number one, we're seeing a lot of commercial real estate debt that's set to readjust in the coming 24 months. And number two, this face of commercial real estate has changed. So let me give you an example of what this means. If you bought a commercial building, let's say a $10 million building, an office building back in 2020, okay, you might have gotten an interest rate of 3 or 4% interest rate mortgage rate on your loan. Well, now, if that building is only 50% occupied, kind of like what all office buildings across the United States are, that means your revenues have fallen because people are not paying rent. And if you're struggling to find new tenants, that means you're going to struggle to make more money. Okay, maybe you can get by because you have some other investments, you have some other money, you have some other income that you can help fund the expenses on this building, or maybe you decide to sell it. But what we're starting to see happen is in the next 24 months, about half of all commercial real estate debt is set to readjust. The interest rates are set to readjust. So if your mortgage payment goes from 3% to 7 or 8% on that $10 million property, your payments are going to skyrocket. Your expenses are going to skyrocket. Now, generally, not that big of a deal, because then what you do is you raise the rent to your tenants. You charge the businesses that are operating there more money, and you can still make the payments. Today, if you have an office building and it's 50% occupied, and now you have to make double your mortgage payments, you're in a very tough situation. And this is what now people are looking at, where what is going to happen in the commercial real estate market 24 months from now that we don't have an answer for. Because if interest rates still stay high, that can create a lot of concerns in the commercial real estate market. And that's something we're going to be seeing 24 months from now.
Yeah, is that where you see maybe the Blackrocks or those big institutions coming in, buying up everything when those investors become distressed, and then from there they try and convert it to, I guess, other assets? So I know you've talked about sort of the new world order and how these asset managers are going to come along and take control of a lot of assets. Is that interrelated, or are those sort of different trends?
What BlackRock is doing, I mean, what they're trying to do is they're just trying to maximize their portfolio. BlackRock is a private institution, and what they want to do is they want to get the best returns on their money. And the interesting thing about a company like, say, BlackRock is that they leveraged their portfolio, which in this instance, many of it was stocks. They leveraged their stock portfolio to then go out and buy hard assets like real estate. And the reason why that's interesting is because, number one, this was the first big move we have seen of hedge funds and institutions, not just BlackRock, but there's other companies doing this as well, buying single family homes in America to rent out. There was a study that I read, I forget exactly where, but it said something that around 1 out of 4 homes in certain neighborhoods were then being bought up by institutions and hedge funds. Now, of course, this is not completely all across America, but in certain neighborhoods, that's the extent of what we saw. And their goal was to rent it out and generate cash flow. And they have seen some success with it. They've also seen some failures with it. We've seen a lot of institutions kind of start it, try it, fail. Some have seen some success. That's kind of been, I think a lot of institutions are realizing that managing rental properties is a lot harder than what they originally planned and budgeted for. But now the interesting thing is, if we were to see a stock market downturn, then what? Because if you leverage up your stock market portfolio and then stock prices, say, crash, then you could be forced to make like a margin call. You could be forced to then put in money to cover those losses. And if that money is then tied up in real estate, that could potentially force you to liquidate some of your real estate. And so if you own a lot of real estate in the country and you see a stock market crash, and then you're forced to find some money to make up for those losses in the stock market, you could be forced to liquidate real estate, which could, drastically increase the supply of real estate for sale. That's something that we haven't seen yet, but it could be something interesting to pay attention to if we continue to see more economic pain, if we were to see more pain in the stock market, because that could kind of flip the way that market dynamics work.
Yeah, but I guess for BlackRock, they probably are loaning to, they're probably giving themselves leverage. So maybe the money's coming from somewhere else within the institution. So they might be able to get away with it. But I guess if it's those hedge funds, they would probably be a lot more risk of defaulting on them.
Every company, including BlackRock, would be facing the same things.
Okay. So yeah, as you said, that could be a massive catalyst for a downturn in that market. So it sounds like, yeah, as you said, it's quite uncertain in the next 12, 24 months, probably more likelihood of downside risk. So from your perspective, how you mentioned there that these are the times that people can become millionaires, that people can sort of benefit from the opportunity. So how can they sort of, I guess, position themselves to benefit? I know you have a framework. I think it's the six steps to sort of become a millionaire, but I'm assuming that's going to be quite useful during these periods. Are there any other methods, or maybe you can explain that, is there anything else that you would that people would be able to do?
So the first thing you have to do is really just understand, number one, what's happening. Number two, build your financial education. And then number three, be prepared. Those are the three things that you should do. Number one, understand what's happening. Look, the reality is there's a lot of crap on the internet and there's a lot of emotions on the internet, and most of the traditional media is in the business of just selling headlines and selling clicks. It's a game. And so it's very difficult, because then it's very easy to be sucked into that game where you see crazy headlines of either the world ending or of nothing bad going wrong. And that clickbaity, sensationalist game can be very annoying. And trust me, I get it, because I'm on YouTube. And if you don't have an attractive title, your video ends up in the YouTube graveyard. I'm very open about that, where it's the way of the internet. And so the first thing is, when you are reading what's happening, the best way for you to get your news is to read the raw data. Read the press releases, read the reports, read the surveys, read the actual data. That way you can have the raw information without all the emotion, because what happens is you get this raw data that gets released, and then all the media companies will pick it up, add their own spices on it, and make it more of a interesting story with a bunch of headlines and crap. And that's what makes people want to click on it. So avoid the emotion, read the raw data. Now, if you don't want to or spend the time on doing it, that's why I've been working really hard to build something called Market Briefs, which is my free financial newsletter. It's a free and easy way for anyone to stay up to date on what's happening in the financial news. You can read it in less than 5 minutes every morning, and my team is working to kind of break down the raw data. That way you understand what's happening when it's happening. So that's Market Briefs. You can go to briefs.co/market to join that. The second thing is to build your financial education. Building your financial education means you are learning how to invest, what to invest in, how to find opportunities. Because the next question everyone has is, well, where's the opportunity going to be? Look, everyone's opportunity is going to be different. And the opportunities are always changing. Like in 2008, the opportunity was pretty obvious. It was in the real estate market, but people also made huge fortunes in the stock market. People also made huge fortunes investing in businesses, buying businesses. People also made huge fortunes investing in land. There's many different types of opportunities and finding the right opportunity for you. So right now, using this time to learn about investing, learn about real estate investing, learn about stock market investing, learn about different types of investing, different ways to build things, maybe even building your own businesses. Some of the most powerful and strongest businesses we know today were started during recessions. So now how can you capitalize on opportunities? That's what financial education is all about. And there's thankfully now a ton of free content on YouTube. I mean, I have my channel, Minority Mindset. There's tons of channels. Find the one that you find best for you and just start learning. Learn. Use this as a time to learn. And then third, be prepared. Being prepared means having access to money. You can find the most amazing investment opportunity in the world, but if you don't have the money or the ability to capture, take advantage of that opportunity, it doesn't do you any good. And so this is where now you got to do two things: spend less and earn more, with the goal of now investing more aggressively. And this is where I say 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. That way you can put some cash aside to be able to capitalize on opportunities. Now, just think about this now logically. You can agree with me or disagree with me. If you think nothing bad is going to happen, or if you think something bad is going to happen in the economy, it does not hurt you to be prepared. Because now, if nothing bad were to happen in the economy and you're prepared, well, you just have some extra cash in the bank and you can go to Disney World, or you can have some more money to invest. But if something bad happens and you're prepared, well, now you can capitalize on investment opportunities, meaning buy good investments at a discounted price. But then the third option is, if something bad happens and you're not prepared, well, now you're the ones that's paying the price. Not only can you not capitalize on opportunities, but you might not have the financial means to protect yourself in case something bad happens. So this is where that financial preparedness and that financial education go hand in hand. That way you can take care of your family's finances and take care of yourself.
Yeah, it's great. And I guess, as you said, it's the opportunity is going to be different for each person. But from your perspective, what are some things that you're looking just to take advantage of in the next 12 24 months?
Well, I invest my money in 5 places. Number 1 is in my own business, Briefs Media, like I was just talking about. And then I also invest in startups. So that kind of ties into business. Number 2 is I invest in real estate, physical real estate. Number 3, I invest in stocks. Number 4, I invest some of my money in cryptocurrency. And number 5, I invest some of my money in physical gold. I do not recommend what I do to anybody. Always do your own research and find the best opportunities and investments for you. I'm an entrepreneur. So for me, investing into my own business is my largest investment, because now I can build and create opportunities. Talking about market briefs, the whole idea for market briefs really started and accelerated during the pandemic, because I went from making about 3 videos a week to 7 videos a week, essentially overnight, when the pandemic hit, because the whole economy got flipped upside down and there were so many things happening so quickly. Now, in order for me to keep up with 7 videos a week, I needed help to keep up with all the information, because I was doing a whole lot of different things as well. And that was when I asked my team to then send me a daily briefing of what was happening in the markets. And so they started sending me these daily briefings. I started making these videos, and I said, why don't we just give these daily briefings away to the audience? Not really knowing where it was going to go. And being the original person that I am, I said, all right, let's call it the Minority Mindset Newsletter. So the Minority Mindset Newsletter started, and we offered this free newsletter to people who wanted to join. And I would kind of just mention it here and there on my videos. Well, come early 2022, that was when I said, we can turn this Minority Mindset Newsletter into something of itself. It can build it into its own business. So that was when I separated the Minority Mindset newsletter to Briefs Media, and we created market briefs. We created business briefs, a newsletter for entrepreneurs and business owners. And now that became its own brand. So for me, that has been and is the biggest opportunity for me, because I see a lot of opportunity in building my own business. I see the opportunity in growing the brand. I see the opportunity in leveraging what I'm doing at Briefs Media. I still invest in stocks. I still invest in real estate, not as much as I used to, but you got to find what's right for you. Now, I do also want to give a little caveat here, because 80% of my investment portfolio is real estate and stocks. 20%, the other 20% is what I call speculative. 2 out of the 20% is physical gold, which leaves about 18% for my startup investments and my cryptocurrency investments. I think cryptocurrency is obviously, a very confusing asset class. And the one thing that I want to say is, if you don't understand it, if you don't believe in it, if you don't want to put the time researching into it, and if you cannot handle the risk and the volatility, do not invest in cryptocurrency. It is not for most people. The biggest problem is a lot of people look at cryptocurrency like it's a get-rich-quick scheme. Then you put money in thinking you're going to make a lot of money very quickly. You lose some money, you get very angry, and you hate the whole system. There's a lot of value in the blockchain, but if you don't believe it, please do not invest in it. It's not for you. I also understand, for me, that if it went down to zero, it wouldn't affect me. Small piece of my portfolio. So you have to understand now how to invest your money strategically in a way that allows you to build long-term wealth through sustainable investments.
Yeah, and that's key. So if we look at, I guess the macro drivers you mentioned at the start of the video, do they at all affect your sort of portfolio construction, or I guess your sort of balancing, or is it not really? It's just understanding what's coming in the future, and then you can prepare to maybe invest more if you wanted to. How does that affect your portfolio?
Does not affect me at all. If we see more pain in the economy, if we see more pain in asset classes, then I just invest more in that. If the stock market crashes, I will put more money into the stock market. If the real estate market crashes, I'll put more money into real estate. If startup valuations crash, I'll buy more or invest more money into the startup market. It's just for me, I look for opportunities wherever the opportunities are. I don't build a rigid framework where this is set in stone and I have to invest this particular way. If an opportunity comes my way, I will take advantage of it.
Yeah, it makes sense. So, Jaspreet, thank you so much for your time. I really appreciate it. I guess my last question is, what is one message you'd like people to take away from our conversation?
Well, I think the one thing that I'd like everyone to take away, which I don't think we got too much into, is really, you can create the life that you want. I think many of us grow up with dreams financially of how we would like to live our lives. But then somewhere along the way, something changes. But the one thing that I really like to emphasize is that there is no limit to what you can do. It does not matter how old you are. It doesn't matter where you come from. It doesn't matter who your parents are. It doesn't matter what your background is. It does not matter how you look. In this world with technology now, there is an unlimited number of opportunities for you to create the life that you want. And I know, there's this big thing of, oh, but is this going to pay? Does money matter? Look, money is important because that's what's going to buy you the financial freedom. And that's where I don't want you to get obsessed over money, but rather understand how money plays a part in your life. That way you can get more money so you can have more financial freedom to do more of the things that you want to do. And that is accessible, number one, now because of the financial education that you can get access to. And then number two, because of what technology allows you to do. It allows you to create and it allows you to earn. So if there is something that you want to achieve, if there's something you want to do, it is possible. It's never too late. There's an unlimited number of opportunities around you, but you have to be willing to go out and get it.
So I know it might be opening another can of worms, but how would someone sort of go after what they want in life?
You start by learning, then you start by doing. You are going to fail. That is a part of success. You have to be willing to try things. You have to be willing to make mistakes. You have to be willing to put yourself out there. You have to be willing to get criticized. One of the most difficult part about becoming successful at anything is the amount of criticism and hate that you're going to get along the way. And the hate is going to change along many different paths. Because in the beginning, when you tell somebody you're going to do something different, they're going to look at you like you lost your mind. Well, that's risky. Why would you want to do that? You have a stable job right here. Don't do that. And then as you start to see some success, you start to become the underdog and everybody likes to support you. Oh, yeah, you go and do it. I've been supporting you my whole life. And then if you start to see some more success, everybody starts to hate you because now you're actually becoming successful, because people want you to become successful, but they just don't want you to become more successful than them. And then as you start to reach that higher level of success, that's when you start to see this shift where everyone starts to kind of become jealous. They start to come up with reasons as to how you got there. They start to create excuses. They start to say things about you. And whether you're on the internet or not on the internet, that's kind of the general path. And that's where you have to kind of stick with what you're trying to do, put your head down, focus on you, and continue building whatever it is that you're building, and ignore the noise. And that is one of the most difficult parts of success, which isn't actually building anything. It's the mindset. It's what's between your ears that allows you to continue doing what's important to you without what everybody else says.
Yeah, it's a great message, especially if you're putting stuff online. You really have to be strong-skinned, and it's end of the day, it's just yeah, just got to keep moving ahead and focus, listen to feedback, but you know what's rubbish and you know what's not, and learning from that. But yeah, thank you so much for your time. So you mentioned a few of your sort of what places people can find your work. So the minority mindset as well as market briefs. Are those the best places? Is there anywhere else people can find what you do?
Absolutely. So yeah, you can check out Minority Mindset on YouTube, Instagram, and everywhere else. And then you can check out Briefs Media, briefs.co. Market Briefs is our newsletter for investors. That's briefs.co/market. And then we have Business Briefs, which is our newsletter for entrepreneurs, briefs.co/business.
Awesome. I'll put that on this description below. So thanks again for your time.
Thank you, man. Appreciate you having me on.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.